Hello everyone. So in this recording we are going to discuss the chapter about investing in stocks. So generally when we refer to stock markets we refer to various indices. So an index is a statistical measure of change in a portfolio or a stock representing a portion of the overall market. So the most famous index in Canada is SAP TSX Composite Index. So composite means it is composed of almost all the companies that are traded in Toronto Stock Exchange, right? So it's a good reflection of how market is doing. If the index is going up, we say the markets are going up. If index is going down, we say markets are going down. Now it doesn't mean that every stock in the index is going up. It means majority are. Then Dow Jones Industrial Average consists of 30 stocks, 30 large cap companies, so bigger companies that are traded in the United States. NYSE Composite, so anything that has composite in it considers all the companies. So NYSE Composite has all companies that are traded in New York Stock Exchange. Nasdaq Composite has almost all companies that are traded in Nasdaq. And S&P 500, it's composed of mid caps and means generally large cap companies, 500 big companies that are traded in America. So why do companies issue common stock? So there are two types of corporation: public corporation and private corporation. So public corporations, so stocks are traded openly in stock markets and may be purchased by individuals. For private corporations, stocks are owned by relatively few people and not traded openly in stock market. Generally, both of them, public or private, issue stocks to finance business startup cost and help pay for business activities. Equity is a form of ownership, so they don't have to repay the money. So whenever a company issues stock, if you buy stock from Apple directly, then Apple doesn't have to pay you back the money whatever you pay to acquire its stocks. So they don't have to repay the money. Price is determined by how much the buyer is willing to pay, and dividends are not mandatory. So equity, whenever a company issues equity, they get money for selling their ownership. They don't have to return back the money that they get from the investors, and even dividends are not mandatory to be paid. Most of the companies have stable dividend policy, but it's not mandatory to pay dividends. Why corporations issue stock? Continuing with that, so stockholders have voting rights and control of the company. So stockholders are owners, so stockholders vote on major decisions of the company. They vote to appoint board of directors in the company, and they vote in case of mergers, acquisitions, and any kind of capital issue. So it may be an equity issue, preference issue, etc. They vote on that. So voting is generally done either directly or through a proxy. So proxy voting is a legal form that lists the issues to be decided at the shareholders meeting and requests the shareholders to transfer their voting rights to another. So if I vote through a proxy, so I'll give up my voting right to someone who will vote on my behalf. Preemptive rights, the right of current shareholders to purchase any new stock that the corporations issues before it is offered to a general public. So this is called as a right issue. Right issue means the current shareholder has the first right of refusal. So if a company is coming up with new equity issues, then the first right of refusal comes to the current shareholder, right? Why do investors purchase common stock or equity? So income from dividend, so cash, additional stocks, or company's product are generally shared with shareholders. Most common type is the cash dividend. So company makes profit, out of those profits some part of it company shares to normal shareholders, so that is called as cash dividend. Additional stocks can be given, so dividends can be shared in from form of additional stocks called as stock dividends, or sometimes it's very rare but companies can share their products with the shareholders. Then As a shareholder, the value of your shares may also change. So appreciation in value over time if the company is doing well. Possible increased value from stock split. So this is the third thing. So you get dividend, you get capital appreciation. So buy at one price and the price goes up and sell at some Y price. And also stock split. So stock splits means, so from one stock you create many different stocks, so you split the stock. So from one stock you're creating many another stocks, right? So possible increased value from stock split. Stock split is a procedure in which the shares of common stocks owned by existing shareholders are divided into larger number of shares. So from one stock you create two stocks or more. Now what are preferred stock? Preferred stock means the dividends are fixed, right? That's the first difference. In common stocks, dividends are not fixed. In preferred stocks, the dividends are fixed. Second difference that preference share have is dividends to preference shares are paid before common stock. Third difference is when the company closes down, preference shareholders are paid before common stockholders. So preference in dividends and preference in closure of the company. That's the two characteristics of preference shares. And stable dividends. So receives cash dividends before common stockholders are paid any cash dividends. Dividend amount is either a stated amount of money for each share of preferred stock or as a percentage of par value. So dividends are fixed. It is either fixed in dollar terms or it is expressed as a percentage of par. Par value is an assigned dollar value that is printed on stock certificate. So they have first claim on corporation's asset in if a foreclosure or if bankruptcy is filed. Callable preference stock is the stock a corporation may exchange for a specified amount of money. So callable preferred stock means normal preferred stock doesn't have a term. So the company doesn't have an option to buy it back. So once it is issued, the company has to pay on dividend until and unless the company is incorporated. So company is in existent, it has to pay dividend. But callable means company can pay off the preference shareholders and cancel off the obligation. So most of the preferred stocks issued are callable preferred stocks. Okay, they are exchanged for a specified. So callable preferred stock is a stock a corporation may exchange for a specified amount of money. After calling an issue, they can issue new preferred stocks with a lower dividend. So generally it is done by when the dividend yield goes down. Some features of preferred stock. So there are different types. So cumulative feature. Cumulative means preference shares have generally a fixed dividend policy. That is, the dividends are fixed. But sometimes if company is not profitable, the board of directors may elect to skip the preference dividend. So if the dividend is skipped, you don't get dividend that year. So cumulative is an option that safeguards you from that. So cumulative means unpaid cash dividends accumulate. So unpaid means the dividends that have not been paid in previous years, they accumulate and must be paid before any cash dividends are paid to common stockholders. So you get dividends before, means preference share gets dividends paid before common stocks are paid. So if you skip any dividend, if your dividend has been skipped, so they will accumulate and they would be paid in the future. Participation features. So it's a rare form of investments used to attract investors. So it means that preference shareholders get the fixed dividends from the preference shares. Along with that, they share the dividend that the common shares issue or common shares are getting. So you get two dividends, one from the preference shares and one from participating with the common shares. So it's a rare form of investment used to attract investors, can share in earnings beyond the stated dividend amount. Then preferred stocks can also be convertible. Conversion features can be traded, means preferred stocks can be converted into common stocks. Now Whenever you buy a stock, we have to value the stock. So how do you value a stock? So important to understand, there are different approaches used by experts to analyze stocks. So fundamental analysis, a way to value stock by looking at micro and macro factors. So micro means things that are specific to company, like the financial statements, the current CEO, right, the strategy that the company is using, the products that the company has, etc. And the macro is the things that are impacting the overall economy. For example, elections, then economic things, economic indicators, all those things that are affecting the macro thing. So you look at micro and macro factors that might influence the economic value of stock. Technical analysis is the idea that changes in investor sentiment, so changes in number of buyers and number of sellers, would impact the changes in trend, and the value of stocks can be predicted by looking at past data. So you look at past charts and try to predict what will happen in future. Efficient market hypothesis states that the future prices cannot be predicted from past trends and patterns. Okay, so it says that using technical analysis has very limited utility. So efficient markets hypothesis means that if you use technical analysis, you cannot get above average return for a long period of time. You cannot beat the markets. For an investor, efficient market hypothesis has several implications. So stock prices move randomly and therefore cannot be predicted from past trend in a consistent manner. The current market price of the security reflects its true value, therefore it is difficult, if not impossible, to find bargains. Securities are priced and traded on their expected risk return metrics and not on their unique features. Prices incorporate new information almost instantly, and excess returns are always almost impossible to obtain based on historical information. So, history cannot be used to predict the future. Market index such as S&P, TSX Composite, and other aggregate market trends are usually leading indicators of future economic prospects and serve as benchmark to the price behavior of the average stock. The relationship between risk and return is positive, and the average risk premium remains the same over a period of time. So it means that fundamental analysis has still utility, but technical analysis has limited utility in stock valuation. Now, classification of stocks. So this is an important topic, so please focus. So there are different classifications. First is blue chip stock. So blue chip stock means these are safe investments in strong and respectable companies, and they generally attract conservative investors. So means these are big companies, they have been there for x number of years, so they have long history of performance and they're relatively safe. Example, Bell or Royal Bank are considered to be blue chip stock. Income stocks, these are stocks that pay higher than average dividends. Example, utility stocks. So whatever dividends on an average and SAP or TSX Composite pays, these companies pay higher dividend than that. Growth stocks earn above average profits for of all firms in the economy, less than 30%. So growth stock means these are growing companies, so they pay very less dividend. Most of the profits that they are getting, they reinvest into business to grow. So less than 30% of earnings are paid out of dividend, with rest reinvested in research and development. Example, Southwest Airlines or Home Depot or Facebook. These are kind of growth stocks. Then cyclical stocks. So cyclical stock means these stocks move along with economy. So if economy is performing well, these stocks generally do well. If economy is going slow, so these stocks starts to means there can be an impact on the prices of these stocks. So these are based on economic performance. Example, auto stocks. So when the economy is booming, auto stocks generally do well because people start buying cars, and if economy is slowing down, the auto sales are impacted and the stock prices are impacted for auto companies. Okay, so follow the business cycle of advances and declines in the economy. Defensive stocks, these remain same during the declines in the economy. Example, pharma. So no matter what happens to an economy, we still buy medicines. So pharma stocks are less impacted by the economic changes than some of the aggressive or cyclical stocks. Then there are large cap stocks, so issued by large corporations that have large amount of stock outstanding and a large amount of capitalization, so billions. So if the company valuation is in billions, these are considered as large cap. Then what is capitalization? So the total amount of securities, stocks and bond issued by corporations. Small cap stocks are issued by companies that have capitalization of 150 million or less. So these are small size companies. So 150 million or less is small cap, 150 to $1 billion is mid cap, and 1 billion plus is generally considered to be large cap. Penny stocks are very extremely speculative stocks. So these companies have very erratic earnings and not a stable earnings cycle and etc. And these are generally traded less than $1. So typically sell for less than $1. Now, where do you get sources? Where do you get information on stocks? So you get it from newspaper, the internet. So you can actually buy stock advisory services, so they generally charge a fee. There are hundreds to choose from. Then you get corporate news from the corporations themselves, so they disclose informations about corporate earnings, assets and liabilities, products and services. So all corporations that are listed in Canada have to disclose their financial information on SEDAR. So SEDAR is a place where you can get information about almost all publicly listed companies in Canada. So this is an example of how information is shown. So this is the company name, the current price, the change, how much it is going up and down, the volume, the chart of the company, the price chart of the company over time, and open, high, low, close, and other stock information. So few things that are generally see when you see a stock quote on different websites. So you see name of the company, the lowest price paid for one share in the past 52 weeks, the highest price in 52 weeks, so 52 weeks low and 52 weeks high that the share had, ticker symbol, then the annual dividend. So dividends are mostly paid quarterly in Canada, so but the dividend that is shown is generally annual, right? So quarterly dividend multiplied by 4, so the annual dividend. So yield percentage, so dividend yield, so current share price divided by the dividend, that gives you how much percentage dividend you are getting right now if you buy the stock. Price earnings ratio, so it is price of the stock divided by earning per share. It means how much is a typical investor paying for $1 earned by the company. How much times does the investor pay for $1 earned by the company? Market capitalization of Finning International. What is the size of Finning International? Highest price paid for one share, lowest price paid for one share in the day, price paid for the last transaction. So highest price in the day, lowest price in the day, the last price in the day, difference between price paid for last transaction and the price paid for last transaction in the previous day. So the change, ex dividend date, interim earning per share. So an EPS data is given, annual earning per share, number of shares outstanding, 52-week price trend, exchange where it is traded, and beta. Beta is how does it relate to the movement of index. So beta means beta of more than 1 means the stock moves more than the index, and beta of less than 1 means the stock moves lesser than the index on an average. Then mostly ratings are given by stock research companies, so buy, hold, and sell ratings. And sometimes means adjectives are used like strong buy, weak buy, hold, etc. So factors that influence a stock price. So markets influence stock price of a particular stock. Example, if bull market is going on, so the sentiments are good and people are buying stocks, then generally it has a positive impact on an individual stock price. So in a bull market, investors are optimistic about the nation's economy. More investors are buying stock and the stock prices are generally rising. In a bear market, investors are pessimist about the economy. More investors are selling stocks, so the stock prices are falling. Measures of corporate risk, performance, and shareholders return. So shareholders return is composed of the returns you get from dividends and the appreciation in value that you get during that year. So a stock's annual dividend and the increase in value divided by the beginning of the year stock price is annual shareholders return. So annual dividend plus appreciation in value divided by initial stock price. Dividend yield is how much dividends are you getting in terms of the price that you bought the share at. So a stock's annual dividend is divided by the beginning of the year stock price. If the dividend is divided by the end of the year stock price, is referred to as trailing dividend yield. So annual dividend divided by initial stock investment. Capital gains, this is appreciation in stock price divided by initial stock investment. Earning per share, this is an important indicator. This means how much is the company earning, right, per share for a particular shareholder. So are the corporations after tax earnings divided by number of outstanding shares. So profits after tax divided by number of stocks. This gives EPS. Price earning ratio. So price of one share divided by earning per share over the last 12 months. So a low price earning ratio means a stock could be a good investment. So price per share, the market price of the stock divided by earning per share of the stock in last 12 months. It means how much is a particular shareholder paying for $1 earned by the company in the last 12 months. So generally you would want to buy the stock in a bargain. So lower the PE ratio, better it is for you. Now beta is an index that compares the risk associated with a specific stock issue with the risk of stock market in general. Beta of lower than 1, so the risk of stock is generally low. Beta of 1, so the stock is an average risk stock, and the beta of more than 1 means the stock moves, it has more risk than average. So it is how aggressive the stock is. So stocks that are defensive generally have a lower beta. So the conservative stocks have lower beta, so their beta is less than 1. Stocks that are on an average same risk as the market, they have 1 beta, and stocks that are more aggressive, they have higher beta. Now you can buy stocks either in primary market or in secondary market. So primary market for stocks, a market in which investor purchases financial security via an investment bank or another representative directly from the issuer. So the issuing company is selling you stocks. You're not buying it from another investor. You're buying it directly from the source, that is the issuing company. And you buy it through an investment bank. An investment bank is a financial firm that assists the corporations in raising funds, usually by helping to sell new securities. An initial public offering occurs when a corporation sells stocks to general public for the first time. Secondary market for stocks, a market for existing financial securities that are currently traded among investors. So secondary markets means you're not buying it from the company, you're buying it from another investor through a broker or through a dealer. right? So the company doesn't get any funds when you do a secondary market transaction. A marketplace where member brokers who represent investors meet to buy and sell securities. The securities sold at an exchange must be listed or accepted for trading at the exchange. Example, Toronto Stock Exchange or Canadian Venture Exchange. So you can buy and sell stocks there. You can also buy over the counter. Over the counter means it's not an exchange, but it's a network of dealers who buy and sell securities of companies not listed on securities exchange. So Nasdaq is an example. So Nasdaq is the biggest over the counter exchange in America. Then brokerage firms and account executives. You generally buy stocks through a brokerage firm. An account executive or a stockbroker is a licensed individual who buy and sell security for his clients. So you have to be careful about churning. So most of the account executives may try to churn your portfolio, that is excessive buying and selling securities to generate commissions, but it is illegal. They are not supposed to do it, so you can sue them if they start doing that. Discount brokerage versus full brokerage. So there are two types of brokering house. So discount brokerage focus on low cost, but their services are mostly paid. So if you want any additional service, you have to pay for it. You want advice, you have to pay for it. But if you don't want advice, you can go to a discount broker because the price are generally very low. Full service brokers give you advice also. So advice is built into their service. So generally the cost of full service brokers are high. So cost of research material is a factor. So they help in making decisions, the full service brokers, and there is ease of buying and selling in terms of discount brokers because mostly they are online. So who should go for a full service broker? So beginning investors with little or no experience, individuals who do not have time to research or are uncomfortable making investment decisions and they need help, they generally go for full service brokers. Discount brokers, people who understand the how of researching stock and prefer making their own decisions. So cost is a major thing there. Individuals who are comfortable in trading stocks online generally go for it. Now continuing with it. So consider how easy it is to buy and sell a stock and other securities when using either a full service or a discount brokerage firm. Questions to ask include: can I buy the stock over the phone? Can I trade stocks online? What is your nearest office located? Do you have a customer service number? How often do I get statements? Is there charges for statement, research reports, and other financial reports? Are there any fees in addition to commissions I pay when I buy or sell the stocks? Is the minimum amount of money that I need to invest? So all this questions are important while choosing a particular firm. Then there are different types of order that you can put when you're buying and selling stocks. So a market order is a request to buy or sell a stock at the current market price. So you don't mention a price. Whatever price is going on in the market, you buy and sell at that. A limit order is a request to buy or sell a stock at a specified price or a range. So in limit orders, you specify a price. In market orders, you don't specify a price. You buy at the best possible price that is there in the market. Limit price, you specify what price do you want to buy at and what price do you want to sell at. And if the price, if the market gives you price better than that or at that price, this transaction will happen. A stop order is a request to sell a stock at the next available opportunity after its market price reaches a specified amount. So this is generally done to protect your losses. So if you buy a stock at $100 and you're thinking the maximum you want to lose on this stock is $10. So what you can do, you can put a stop loss sell order at 90. If the stock goes to 90 or below, the stock is sold automatically. So it protects your gains or it protects you from having bigger losses. A discretionary order lets the account executives decide when to execute the transaction and at what price. So generally don't use discretionary order because then you lose control. So you just say that I want to sell this stock, and it is up to the account manager to decide when to do it and at what price. So don't do that. Computerized transactions. So discount brokerage firms and full service brokerage firms allow investors to trade online. It makes the process cheaper and faster. Now commissions range depending on the service. So generally trading happens in a standard lot or an odd lot. Standard lots is 100 units of a particular share. An odd lot is anything that is different from multiples of 100. So if you trade in standard lots, the commissions are generally lower. If you trade in odd lots, the commissions are generally higher. So this is example of commissions from different players. So if you see, it's generally $5 to $10 depending on the firm you go for, and you can just pause this slide and look at the commissions from different players. Security regulations to ensure full, true and plain disclosure of fact by sellers and security. So how is security markets regulated? So security market is regulated in Canada at provincial level. So every province has a security legislation that applies to companies that are within the province. Second, it is also regulated at an SRO level. So SRO is a self-regulatory organization. So IIROC is a self-regulatory organizations that almost all dealers are attached to. So they regulate it, and it is also regulated as exchanges. So it is regulated at exchange at an SRO called as IIROC, and it is also regulated at province. So provincial regulation consists of registrations of companies and dealers, disclosure of all information to an investor, and enforcement if something goes wrong. Self-regulatory organizations are responsible for industry conformity with security legislations. Now, these are some long-term techniques that investors use to trade in stocks. So first is diversification, involves combining many assets in a portfolio to reduce the risk. So diversification means that you don't want to overexpose yourself to a particular industry or to a particular stock. So instead of putting all your money in one stock or in one industry, you divide your money in different stocks across different industries. Buy and hold technique. So portfolio value increases through dividend payment, appreciation in stock value and dividend reinvestment. Buy and hold means you buy good stock and give time. So you search for companies that are doing good over the past and who have good prospects in future, buy them and stay with them, and you get appreciations in form of dividends, dividend reinvestments that you do, as well as the appreciation in price. Now dollar cost and averaging means instead of investing lump sum amount in a particular stock, you invest a regular amount, right? So investor purchase an equal dollar amount of the same stock at equal intervals. So what it does is stock may go up and down, right? So you don't know whether it's what price are you going to get. So instead of focusing on buying at low and selling at high, you keep on buying the stock at regular interval, some dollar amount. So you average the price. Next is direct investments and dividend reinvestments. So you sometimes the corporation gives you this options that you can directly buy from the company, so you save on commissions, or the dividend that the company is paying is automatically reinvested by giving you additional stocks. So purchase stocks directly from the corporation and reinvest dividends to purchase more stocks. Now private equity is an asset class comprising of equity securities that are not publicly traded. So these are generally smaller companies and growing companies that are not listed on the stock exchange. Now, short-term techniques include hedge funds. So, in investment funds that serves to a group of investors. So, it's like a mutual fund. So, investors collaborate their money, give it to a fund manager, and the objective of fund manager is to protect the capital and to grow it. So, hedge funds invest in a lot of securities. So, they buy stocks, they trade in derivatives, they also do short selling, and they try to conserve the capital and grow it. Then short-term techniques also include buying stocks on margin. So margin trading means you can buy or sell on margin, whereby you borrow money to buy on margin or you borrow stocks to sell on margin, right? So the thing with margin trading is profit and losses are amplified, so there is leverage. So if you make profit, the profit is higher than the cash trade. If you make loss, the loss is higher than the cash trade. And there are two types: margin buy or long, and short sell, that is margin sell. You do margin buy if you think stock is going to go up. If you do short sell or margin sell if you think the stock is going to go down. So selling short, borrowing stock that must be repaid later. So you borrow stock, sell it, buy it, and close the position. You can also trade in options. So options are the right to buy or sell a stock at a predetermined price. So there are two types of options: call option and put option. Call option benefits if the stock price goes up. So you can buy call option to bet on price increasing, and put option benefits if price goes down. But it's all for all or nothing. If the price doesn't rise, then you lose money, whatever you have paid for buying that option. Okay, so they have given an example of margin trading. So what do you do? So you typical margin transaction, so it's a buy side margin transaction. So what do you do? Let's say the stock is costing $10,000, then you put your $5,000 and borrow the rest from the broker. Okay, and you trade for entire $10,000. So you buy the stock worth $10,000. 5,000 is your own and 5,000 is borrowed from the broker. The amount that you have borrowed from the broker, you have to pay interest on it. Okay, then if the stock goes up, you sell the stock at higher price, pay off the loan, and pocket the difference. That is how you do it. For example, you invest $5,000, borrow another $5,000, and make $10,000 and trade stock worth $10,000. Okay, so the stock price is $10. So if the stock goes to $14 per share, you sell it at $14, so you get $14,000. 5,000 is used to repay the loan, and rest of the $9,000 you pocket. So on 5,000 you made 9,000. That's $4,000 in profit. But you have to pay interest and commissions on top of it. Short selling, you borrow a stock, sell it, and buy it later. If the stock goes down, you would have sell it at a higher price and bought it at a lower price, so you pocket the difference. So the buy that we have seen earlier benefits if stock price goes up and loses money if stock price goes down. The short that we are looking at right now benefits when the stock price goes down, because you are selling first and then buying. So you decide to borrow stock from the stockbroker and sell it. So using borrowed stocks, you sell it for $90 per share, so you get $9,000 in your account. Later on, the stock goes to $83 per share, so you buy it back at 83 and return the stocks back to the person you have borrowed it from. So you sold at 9,000 and you bought it back at 8,300. So the difference, that is $700, is your profit. So it's very simple. Long trade benefits if the stock goes up, it loses money if stock goes down. Short trade benefits if the stock goes down, and it loses money if the stock goes up. So call option and put option. So this is a complex diagram, but the basic understanding is call option is an option to buy a stock at a particular price. So if the price goes up, you can buy at a lower price than the market. So you benefit. Put option is an option to sell a stock at a particular price. So if stock price goes down, you can sell at a particular price and benefit. So this is what we have seen in company in this chapter. So just going through the summary, corporations sell stocks to finance their startup cost, help to grow their business. People invest because of dividend appreciation in value and gain through stock splits. Dividend payment must be approved by board of directors. So identify the most important features of common stock. Amendment to corporate chapters means they have right, you have the right to vote. So you vote for amendment to corporate chapters, sale of certain assets, mergers, issuance of preferred stocks and corporate changes in amount of common stocks. You vote as a shareholder to decide on these things. Preferred stocks, you receive dividends before common stockholders, and you can have certain extra features like cumulative participation and conversion feature. How do you evaluate stock investment? Information contained in newspaper or internet, and be familiar with typical psychological biases. Two different analytical techniques like fundamentals and technical analysis, and theory of efficient market, which suggests that technical analysis has limited utility. New stocks are bought and sold through an investment bank in primary market or through an investor in secondary market. Most investments done through account executives or online. Minimum commissions are charged for buying and selling stocks. Additional commissions depend on how much you trade. Regulations are in place to protect investors. Some long-term strategies are holding an investment for at least an year. Sorry for that, so it zoomed in. Holding an investment for at least a year, buying a diversified portfolio, buy and hold technique, so give time to your investments. Direct investments plan, and that is buying directly from the company. Dividend reinvestment plans is whatever dividend you get, the company reinvests that. Short-term techniques are selling investments within a short period of time, buying on margin, selling short, and trading in options. So that's it in this recording. We'll see each other in the next recording.